It's better. Pushing my dinner down so I can do this live stream. $1.10 for the Zura. Yeah. $1.50. Yep. Decided to stream the FOMC conference, so yeah. Hey, Firen. But a couple of minutes before it starts, just kind of looking at the Zura. Obviously, we traded Zura, but it's now $1.50 on the $1.50 on the spreads. Well, it's now narrowed to 10 cents, so it's very rangy on the spreads. But the volume's died out, so there's no more trading that. It took two grand off me on that last halt, so I wasn't happy about that. What did I have for my tea? I had double egg and chips with beans. I like that. I'm having a nice cup of tea. So a lot of the what I expected to be kind of volatile today just hasn't been. And a lot of what I didn't expect to be volatile has been. GameStop never really did anything. It kind of just settled around kind of between 24 and 25. Going sideways now, GameStop. So I should have made more on GameStop than I actually did, but coulda, woulda, coulda. You can't go wrong with double egg and chips. Staple where I grew up. Let's get the live stream ready, shall we? So, well, am I actually live on? Yeah, so that's fine. Nobody on YouTube. Have I got anybody watching on the old tube of you? Yeah, make yourself known. Get involved in the chat. So what's we've got the press conference is just starting now, so let's get to this now. So just waiting now for Howell to turn up. And let's see what's going on, shall we? Who was that running past the camera? Come on. I don't know about if it's the end of the rate hikes, but it's the end of something, that's for sure.
Good afternoon. Because a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that all depositors' savings in the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and
Market's pumping again.
all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. Turning to the broader economy and monetary policy, inflation remains too high and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the term of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investments. Committee participants generally expect subdued growth to continue.
No, this is Chair Powell.
As shown in our summary of economic projections.
It's the Chair of the Fed.
The median projection for real GDP
Jerome Powell
stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories. Excluding those, core PCE prices rose 4.7%. In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The median projection in the SEP for total PCE inflation is 3.3% for this year, 2.5% next year, and 2.1% in 2025. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people.
Now it's selling off.
My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our securities holdings. Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation. And our policy decisions will reflect that assessment. In our SEP, each FOMC participant wrote down an appropriate path for the federal funds rate based on what that participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.3% at the end of 2024, and 3.1% at the end of 2025. These are little changed from our December projections, reflecting offsetting factors. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation. We remain committed to bringing inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Colby Smith with the Financial Times. How confident is the committee that the recent stress that we've seen and you've alluded to is contained at this point, and that deposit flight among mid-sized lenders in particular has ceased?
Thanks. So I guess our view is that the banking system is sound, it's resilient, it's got strong capital and liquidity. We took powerful actions with Treasury and the FDIC, which demonstrate that all depositors' savings are safe and that the banking system is safe. Deposit flows in the banking system have stabilized over the last week. And the last thing I'll say is that we're undertaking a thorough internal review that will identify where we can strengthen supervision and regulation.
Okay, just a quick follow-up. I mean, given all of the stress and the uncertainty that you've also alluded to in the statement, how seriously was a pause considered for this meeting?
So we did consider that in the days running up to the meeting, and you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation in the labor market came in stronger than expected, and really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we had expected at the time of the SCP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words. So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening of credit conditions for households and businesses, and thereby weigh on demand, on the labor market, and on inflation. Such a tightening of financial conditions would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike, or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever. So our decision was to move ahead with a 25 basis point hike and to change our guidance, as I mentioned, from ongoing hikes to some additional hikes, maybe some policy firming may be appropriate. So going forward, as I mentioned, in assessing the need for further hikes, we'll be focused, as always, on the incoming data and the evolving outlook, and in particular on our assessment of the actual and expected effects of credit tightening.
Now we're reporting 401 on the SPY.
Mr. Chairman, can you explain the difference between ongoing rate increases and firming? Does firming imply a rate increase per se, or could policy firm without you increasing rates?
No, I think it's meant to refer to our policy rate. Really, I would focus on the words may and some, as opposed to ongoing. So we clearly were, what we were doing there was taking on board trying to reflect the uncertainty about what will happen. I mean, it's possible that this will turn out to have very modest effects. These events will turn out to have very, very modest effects on the economy, in which case, and inflation will continue to be strong, in which case, the path will might look different. It's also possible that this potential tightening will contribute significant tightening in credit conditions over time, and in principle, if that means that monetary policy may have less work to do. We simply don't know. So.
Do you have concerns that the hike you did today could further exacerbate the problem in the banks?
No, I mean, with our monetary policy, we're really focused on macroeconomic outcomes. In particular, we're focused on this potential credit tightening and what can that produce in the way of tighter credit conditions. I think when we think about the situation of the banks, we're focused on our financial stability tools, in particular our lending facilities, the discount window, and also the new facility.
Nick Timrose, the Wall Street Journal. Chair Powell, in your testimony 2 weeks ago, you had indicated you thought the terminal rate would be higher. Obviously, that was before the stress in the banking sector. And I realize there's a lot of uncertainty, but can you explain at all to what extent your forecasts, or those of your colleagues, or those of the board staff incorporated today a material tightening in credit availability because of the stress in the banking sector, or are you waiting to see it in the data before you incorporate that potential tightening into your forecasts?
So, we've just come from an FOMC meeting, and the people who write the minutes will be very carefully counting. But I'll tell you what I heard. What I heard was a significant number of people saying that they anticipated there would be some tightening of credit conditions, and that would really have the same effects as our policies do, and that therefore they were including that in their assessment, and that if that did turn out not to be the case, that in principle you'd need more rate hikes. So some people did reflect that in their SCP forecasts. I think there may also just have been, remember, this is 12 days ago. We're trying to assess something that just is so recent, and it's people, it's very difficult. There's so much uncertainty. So December was a good place to start, and we wound up with very similar outcomes for December. And in a way, the data in the first part, the first 5 weeks of the intermediate period, pointed to stronger inflation and stronger labor markets. So that pointed to higher rates, and then this latter part, kind of the possibility of credit conditions tightening really offset that effectively.
To follow up, have you considered at all whether your primary tool, the funds rate, is going to be enough to sustain the kind
I keep getting requests to stream it live, and when I do, I also get his complaints of how enthralling it is, Jack. So I can't win either way.
Selling assets out of the system, open market account, as a way to better achieve tighter financial conditions that don't accelerate deposit erosion, for example, from banks.
The SPY's up at 401.20s now, so
other tools in effect, but no, we think our monetary policy tool
it's just
works.
double topped up at the kind of 401.60s.
Our rate hikes were well telegraphed to the market, and many banks have managed to handle them.
Hi, Victoria Guida with Politico.
SPY will throw up higher day.
You, along with the FDIC and the Treasury, the Fed Board decided to
Testing 402 on the SPY.
To allow uninsured depositors to be protected at these two banks. I was just wondering if you could speak to why that decision was made. Was it purely a confidence issue, or was there a concern that there would be some sort of economic contagion or financial contagion from the failure of these banks?
The issue was really not about those specific banks, but about the risk of a contagion to other banks and to the financial markets more broadly. That was the issue.
Okay, and then can you also, just to follow up, can you speak to the role that you will be playing in the Fed's internal investigation on its supervision and regulation?
So Vice Chair Barr is of course leading that review, and he's responsible for it in his capacity as
Got a job that wants to play that.
I realized, right away that there was going to be a need for a review. I mean, the question we're all asking ourselves over that first weekend was, how did this happen? And so what we did was early Monday morning we sat down and said, let's do this. And he was obviously going to lead it in his capacity. So I don't, my role was to announce it, and I get briefed on it, but I'm not involved in the work of it.
Well,
Chair Powell, Howard Sutter from Reuters.
this
So,
should finish at the top of the hour, and then we've got power hour to trade. So.
I believe 9 or 10 times, a process that we felt was, I forget the word you used, but gratefully underway or something like that. Is disinflation still occurring in the U.S. today?
Oh, you just ripped Bose's
I
arm.
mean, what actually happened, Howard, was I got the question 12 times. So maybe it's a feature, not a bug. But yeah, absolutely the same. The story is intact. So it's really three parts, right? Goods inflation has been coming down now for 6 months. It's proceeding more slowly than we would have liked, but it's certainly proceeding. Housing services is really a matter of time passing. We continue to see the new leases being signed at much lower levels of inflation. So that's 44% of the core PCE index, where you've got a story that's ongoing. Where we didn't have in February, and we still don't have now, is a sign of progress in the non-housing services sector, and that is, that's just something that will have to come through softening demand and perhaps some softening in labor market conditions. We don't see that yet, and that's of course 56% of the index. So the story is pretty much the same. I will say that the inflation data that we got, to your point, really pointed to stronger inflation.
If I could follow up on that, I was curious why you don't see more coming from the credit crunch, because it seems to me that's something that you'd actually welcome to a degree and expect. And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
So it's really
Market seems very happy, Jack.
At this point, there's a great deal of literature.
GameStop rallying on the back of it.
Tighter credit conditions.
The banks are rallying, and AMC.
Inflation. Very large body of literature. The question is, how significant will this credit tightening be, and how sustained will it be? That's the issue, and we don't really see it yet. It's so people are making estimates. People are publishing estimates, and it's very kind of rule of thumb guesswork almost at this point. But we think it's potentially quite real, and that argues for being alert as we go forward, as we think about further rate hikes. For us, we will be paying attention to the actual and expected effects from that.
Hi, Chair Powell. Gina Smiley from the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit, I know that you've got your internal review coming, but I wonder if you could talk a little bit about what you think happened with oversight at Silicon Valley Bank, and whether this suggests that something about regulation and supervision needs to actually change going forward. And I wonder, how can the American people have confidence that there aren't other weaknesses out there in the banking system, given that this one got missed, as you noted?
So let me say what I think happened, and then I'll come to the questions around supervision. So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk. We now know that supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors, concentrated group of connected depositors, in a very, very fast run, faster than the historical record would suggest. So as for us, so for our part, we're doing a review of supervision and regulation. My only interest is that we identify what went wrong here. How did this happen is the question. What went wrong? Try to find that. We will find that. And then make an assessment of what are the right policies to put in place so that it doesn't happen again, and then implement those policies.
Have policies in place. Trump rolled them back in 2018.
At this stage to offer my views on what the answers might be. I simply can't do that. Vice Chair Barr is leading this, and I think he's testifying next week. So, but that will be up to him. So that's really where it is. The review is going to be thorough and transparent. It is clear, to your last question, it's clear that we do need to strengthen supervision and regulation. And I assume that there will be recommendations coming out of the report, and I plan on supporting them and supporting their implementation.
And the final point, can we feel confident that these weaknesses don't exist elsewhere, given that they got missed at this bank?
These are not weaknesses that are at all broadly through the banking system. This was a bank that was an outlier in terms of both its percentage of uninsured deposits and in terms of its holdings of duration risk. And again, supervisors did get in there, and they were, as you know, obviously, they were on this issue, but nonetheless, this still happened. And so that's really the nature of the review, is to discover that.
Michael McKee from Bloomberg Radio and Television. You've been very consistent in saying that the Fed would be raising interest rates and then holding them there for quite some time. Following today's decision, the markets have now priced in one more increase in May, and then every meeting the rest of this year, they're pricing in rate cuts. Are they getting this totally wrong from the Fed, or is there something different about the way you're looking at it, given that you're now thinking that moves might be appropriate as opposed to ongoing?
So we published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth, a gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
Well, if I could follow up and ask, as you look forward into the rest of the year here, are you saying that what you see and the 5.1% basically consensus is based on it will be sufficiently restrictive, or is it leavened by the idea of you don't know what's going to happen? In other words, what should people think about in terms of how the Fed thinks about how far it is from the terminal?
It's going to depend. Remember, we're looking, for purposes of our monetary policy tool, we're looking at what's happening among the banks and asking, is there going to be some tightening of credit conditions? And then we're thinking about that as effectively doing the same thing with rate hikes.
This will
So
shut
in a
you up.
way, that substitutes for rate hikes. So
I thought you might shut up
the
if I
key
give
is
you one.
we have to have policy that's got to be tight enough to bring inflation down to 2% over time. It doesn't all have to come from rate hikes. It can come from tighter credit conditions. So that we're looking at, and it's highly uncertain how long the situation will be sustained or how significant any of those effects would be. So we're just going to have to watch. In the meantime, and obviously at the end of the day, we will do enough to bring inflation down to 2%. No one should doubt that.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I know we've talked a bit about how Silicon Valley Bank was unique to a certain sector of the economy, but there's also growing concern that there are financial stability risks from the commercial real estate market and loans that will begin to roll over later this year and next, and that smaller regional banks also disproportionately hold those loans. Is there a risk that could mimic the kind of what we saw with SVB to banks that disproportionately are focused on commercial real estate?
So, we're well aware of the concentrations people have in commercial real estate. I really don't think it's comparable to this. The banking system is strong, it is sound, it is resilient, it's well capitalized, and I really don't see that as at all analogous to this.
Question. Would you be open to an independent investigation separate from the Fed's probe?
I welcome that. It's 100% certainty that there will be independent investigations and outside investigations and all that. So we welcome, when a bank fails, there are investigations, and of course, we welcome that.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Inflation has been rather sticky, so do you need help from the fiscal side to get inflation down faster?
We don't assume that. We don't give advice to the fiscal authorities, and we assume that we take fiscal policy as it comes to our front door, stick it in our model along with a million other things, and we have a responsibility for price stability. The Federal Reserve has a responsibility for that, and nothing's going to change that. So we will get inflation down to 2% in time.
And if I could follow on that, but they're working, the spending that's happened is working against what you were doing, right? So it's prolonging inflation?
If you have to look at the impulse from spending, because spending was, of course, tremendously high during the pandemic, and then as the pandemic programs rolled off, spending actually came down, so that the sort of fiscal impulse is actually not what's driving inflation right now. It was at the beginning, perhaps part of what was driving inflation, but that's not really the story now.
Hi, Chair Powell, Neil Irwin with Axios. Two questions about aspects of the government's response on Silicon Valley Bank 2 weekends ago. First, why is this new bank funding facility done under emergency 13.3 authority as opposed to expansion of the discount window, changing the terms of the discount window that's been around a long time? And second, can you discuss the Fed's role in the FDIC guarantee of uninsured depositors and why there's $143 billion on your balance sheets last week supporting that deposit guarantee?
Sure. So 13.3 seemed like the right, we have a little more flexibility on section 13.3. We did retain quite a lot under discount window as well. We needed to do a special facility that was designed a certain way, so we did it under 13.3. Really no magic to that. It's only available in unusual circumstances, and it has to meet certain requirements, but it seemed to be the right place. So with the FDIC, we're lending to in effect, we're lending to the Bridge Bank. So that's where the funds came from, and it's a loan that's 100% guaranteed by the FDIC, so there's no risk in it for us.
Thank you, Chris Rugaber at Associated Press. The SEP suggests one more rate hike, as does the change in the language in the statement, and which suggests that you're perhaps nearing the end of a cycle of rate hikes. Do you feel, though, that if inflation remains high, you'll be able to resume additional hikes as needed, or have you somewhat tied your hands here with these signals about rate hikes coming to an end?
No, absolutely not. No, if we need to raise rates higher, we will. I think for now, though, we as I've mentioned, we see the likelihood of credit tightening. We know that can have an effect on the macroeconomy, on demand, on the labor market, on inflation, and we're going to be watching to see what that is. And we'll also be watching what's happening with inflation and in the labor market. So we'll be watching all those things, and of course we will eventually get to tighten up policy to bring inflation down to 2%. We'll find ourselves at that place.
Hi, Chair Powell. Thanks for taking the question. Kyle Campbell with American Banker. I have a couple questions about the balance sheet. First of all, I'm curious, at what point the financial supports that the Fed is extending through the discount window and through its enhanced lending facility might be at odds with the objective of reducing the balance sheet. And I'm also curious what your thoughts are on not just the availability of reserves, but the distribution of them throughout the banking system, and at what point you might be concerned about it being scarce for certain banks.
So people think of QE and QT in different ways, so let me be clear about how I'm thinking about these recent developments. So recent liquidity provision that has increased the size of our balance sheet, but the intent and the effects of it are very different from when we expand our balance sheet through purchases of longer-term securities. Large-scale purchases of long-term securities are really meant to alter the stance of policy by pushing up the price and down the rates, longer-term rates, which supports demand through channels we understand fairly well. The balance sheet expansion is really temporary lending to banks to meet those special liquidity demands created by the recent tensions. It's not intended to directly alter the stance of monetary policy. We do believe that it's working. It's having its intended effect of bolstering confidence in the banking system and thereby forestalling what might otherwise have been an abrupt and outsized tightening in financial conditions. So that's working. In terms of the distribution of reserves, we don't see ourselves as running into reserve shortages. We think that our program of allowing our balance sheet to run off predictably and passively is working. And of course, we're always prepared to change that if that changes, but we don't see any evidence that that's changed.
Hi, Chair. Katerina Sarajevo with Bloomberg News. The minutes of the January-February meeting, the last meeting, indicate that you discussed the possibility of runs on non-bank financial institutions.
and the impact of large unrealized losses on bank portfolios. Can you talk a little bit more about that discussion, kind of what was talked about in light of that? And then why didn't the Fed, do anything about that at that point to ultimately prevent, what happened this month?
I mean, to be honest, I don't recall the specifics of that. It's quite an interesting 7 weeks, but I will tell you that there have been presentations about interest rate risk. I mean, it's been in all the newspapers. It's not a surprise that there are institutions that have had unhedged long positions in longer duration securities that have lost value as longer term rates have gone up due to our rate increases. So that's not a surprise. I think, as you know, as it is now in the public record, the supervisory team was apparently engaged, very much engaged with the bank repeatedly and was escalating, but nonetheless what happened happened. And so that's really the purpose of one way to think about the review that Vice Chair Barr is conducting, is try to understand how that happened and try to understand how we can do better and what policies we need to change. I mean, one
market doesn't know what it wants.
I'll come back to that. The speed of the
up it's down, it's up, it's down.
It's very different from
up and down like a bride's nightgown.
That there's a need for possible, regulatory and supervisory changes, just because supervision and regulation need to keep up.
Keep it to yourself, Alistair.
Can you confirm whether or not the board knew about these escalations by the examiners in San Francisco?
I will have to come back to you on that. Yeah, I don't know.
Simon Rabinovich with The Economist. Thank you very much. Chair Powell, you stated twice today that all depositors' savings in the banking system are safe. Are you saying that de facto deposit insurance covers all savings? Shouldn't Congress have a say in that? And just by way of example, if a bank with less than $1 billion in assets failed, are you promising to bail out all of its depositors?
What's going on with the SPY now? It's just tanking.
I'm not saying
vomiting.
More than I'm saying. So
the market hasn't been vomiting right now.
That we have the tools to protect depositors when there's a threat of serious harm to the economy or to the financial system.
The markets are vomiting. What's going on?
Use those tools, and I think depositors should assume that their deposits are safe.
Talk about fickle, breaking session laws.
Thank you, Chair Powell. Greg Robb from MarketWatch. I was wondering if you could give us a little bit more color. You gave just a little bit of color. You said during the first week of the Silicon Valley weekend, you said the question you guys asked was, how did this happen when you saw Silicon Valley Bank? So I was wondering if you could go to the Credit Suisse merger.
You're probably right, Nate.
Is that the big gorilla in the room? Didn't you breathe a sigh of relief when that
not really done much
merger happened? Thanks.
Sure. So, that was really the Swiss government. We, of course, were following it over the course of the weekend, and we were engaged with their authorities in the way that you would expect, all the ways that you would expect. It seems to have been a positive outcome in the sense that the transaction was agreed to, and it has been, the markets have accepted it, and it seems to have gone well, and I think there was a concern that it might not go well. So coming into the middle of this week, yes, I would say that has gone well so far.
Hi, thank you, Chair Powell. Nicole Goodkind with CNN Business. In the summary of economic projections, the FOMC sees the unemployment rate increasing to 4.5% this year. I'm wondering how you anticipate preventing this from snowballing while using the admittedly blunt tools at your disposal.
So that's an estimate of what will happen as demand slows and as conditions soften in the labor market, and it's a highly uncertain estimate. And
he wants to put people out of better jobs. That's what he wants.
We have to bring inflation down to 2%. The costs of bringing it down, there are real costs to bring it down to 2%, but the costs of failing are much higher. And if you read your history, as I'm sure you have, you can see that if the central bank doesn't get inflation back in place, make sure that inflation expectations remain anchored, you can have a long series of years where inflation is high and volatile, and it's hard to invest capital. It's hard for an economy to perform well, and we're looking to avoid that, and and to get back to where we need to be, back to where we were for a quarter century, and get there as quickly as we can.
But I guess the question is, historically, it's hard to. Historically, it's been hard to contain unemployment, and the question is, do you worry about some sort of snowball effect, and how do you factor that into your projections?
Well, it depends on whether so recessions tend to be nonlinear, and so they're very hard to model. You know, the models all work.
Nice talking about recession. The market is absolutely puking.
When a recession happens, the reactions tend to be nonlinear, and that's what so we don't know whether that'll happen this time. We don't know. If so, we don't know how significant it will be. And so, you know, we're very focused on getting inflation down, because we know in the longer run that's the thing that will most benefit the people we serve. That's how we can have a long. You know, we've had very strong labor markets through these long expansions that we've had. 4 of the 5 longest, or 3 of the 4 longest expansions in U.S. history have been really since the high inflation period. And the reason was inflation wasn't forcing the central bank to come in and stop an incipient or an expansion. You can have very, very long expansions without high inflation, and we had several.
Market's breaking laws now.
You see late in expansion, you see low unemployment, you see the benefits of wages going to people at the lower end of the wage spectrum. It's just a place that we should try to get back to.
No past yesterday's law.
Hi, Chair Powell. Jean Young with Market News. I just wanted to ask, with all the events of the past 2 weeks, do you still see a possibility of a soft landing for the U.S. economy?
You know, it's too early to say really whether these events have had much of an effect. It's hard for me to see how they would have helped the possibility, but I guess I would just say it's too early to say whether there really have been changes in that. You know, the question will be how long this period is sustained. The longer it's sustained, then the greater will be the likely declines in or tightening in credit standards, credit availability. So we'll just have to see. I do still think, though, that there's a pathway to that. I think that pathway still exists, and you know, we're certainly trying to find it.
Orchestrate a credit crunch.
Hi, Chair Powell, Nancy Marshall.
Make it difficult for small and medium businesses to get credit, so they can't hire, have to lay people off, create higher unemployment, helps with the tackling inflation. Someone's playing 3D chess.
I don't know. But those are serious regulatory, particularly immediate tension. That's and I guess there were 6 of them. So.
And getting to the seriousness of it, how are you going to ensure that banks comply with these citations, take them seriously? How will we enforce them?
That is a great question, and is right in the heart of what the review will be done under Vice Chair Barr's leadership. So I think that's what you think about. You know, what can we do to make sure? But again, that's not for me to answer today.
Do you have specific thoughts on that?
Well, I'd see if I did, I wouldn't share them, because I really, you know, this review is going on, and you know, I want nothing other than us to find out what happened and why, figure out what we can do to do better, and then implement those changes. That's all I want. It's for me to be giving you my half-formed or partially informed thoughts. You know, it just isn't appropriate. There's a real serious review going on with people from all over the Federal Reserve System who are not connected to this, you know, to this work, not connected to this bank, and under again Vice Chair Barr's leadership, and I'm confident that it will produce a satisfactory result.
Okay, we'll go to Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Curious, how do you view financial conditions right now? If credit becomes expensive enough, choking off growth, as you said you're watching for, would that situation warrant a rate cut? What situation would warrant a rate cut? And have the bank failures prompted any discussion around changing the implementation of the balance sheet runoff? Thank you.
So we haven't really talked about changing the balance sheet implementation. That's not something we've discussed yet. As I mentioned, we're always willing to change that if we conclude that it's appropriate, but we're really not seeing any signs there. Sorry, then the question before that was, just give me a...
curious how you view financial conditions now, and if credit were to tighten enough, if that would prompt a rate cut.
So, financial conditions seem to have tightened, and probably by more than the traditional indexes say, because the traditional indexes are focused a lot on rates and equities, and they don't necessarily capture lending conditions. So we think that, though. So there are other measures which if they're focused on, bank lending conditions and things like that, they show some more tightening. The question for us, though, is how significant will that be, and how, what will be the extent of it, and what will be the duration of it? And then, once you know that, there's a fair amount of research about how that with broad uncertainty bands, how that works its way into the economy over what period of time. So, we'll be looking to see the first part of that, like how serious is this, and how does it look like it's going to be sustained? And if it is, it could easily have a significant macroeconomic effect, and we would factor that into our policy decisions. I mentioned with rate cuts, rate cuts are not in our base case, so that's all I can say. So, thank you very much.
Well, I think that's about it. Well, what do you think, guys? Is the economy back on track? I don't think so. I wasn't convinced. The market didn't seem to be convinced either. Well, David, everybody asks me to. Are you going to stream? Are you going to come back for Power Hour? Are you going to stream the FOMC conference? I'm like, yeah, okay, I'll stream the FOMC conference, but don't complain when I've streamed it and it's boring. It's the same every single time. You know what you're getting. What's going on with this? Seem to have lost my Benzinger connection. But yeah, I mean, you look at the SPY. Let's just take a quick look at the markets there. Dip buy opportunity? Yeah, I think so. Look at that. This is the S&P 500 or the SPY. Why not? Well, I'll continue trading for the rest of Power Hour now, and we'll see what happens. What's going on here? Well, I'm gonna have to get the scanners back up and running. It seems. Okay, just bear with me 1 second. The scanners need refreshing. And So the scanners are back up and running. Let's just get the losers on there as well. So we'll see all the biggest movers. Look at this. It's all red. Everything is red. It's awash with red. Looks like the market's time of the month. It really does. That's how much red there's there. But look, but it is what it is. We go again. It's a nice green day. Well, I've got 3.5k on the small account as well, Dillar. So it's another 20k day in total so far. I was over 20k on this one. I gave 2,000 back on Zura Bio. I got caught in a halted up, gap down, like $2.50. I wasn't in big size, only in 1,000 shares, so I suppose there's that much to be thankful for. But let's just have a look at some of the stocks. So this is the SPY. This is the market. We had this move up, then kind of move down. So we've got to move up here with the initial conversation around 2 p.m. for the rate. With the rate decision, and then we had this move up with the conference, then the sell off. But the banks themselves, I mean, look at First Republic. It's pretty much the same pattern. Didn't go green on the day, but again selling off. We've got GameStop. GameStop had a rally and then sold off hard. Along with the market, so now it's trending with the market. So this is something that we've got to be aware of. A lot of these stocks that we're trading are moving with the market. AMC did exactly the same thing. Where are you, AMC? There you go. AMC, pretty much the same chart as GameStop. So yeah, 3,500 $. In the smaller account, yeah. So, in fact, I've just dropped that small account recap on YouTube right now as I'm talking. Why not? There we go. All right, where we go? What's going on there? What else is? What are we seeing in the markets? Got about half an hour to trade. Actually, that's a good question. Let's have a look at the calendar today. I don't think there's much in the way of earnings today. But let's have a look anyway. After hours. I think it's a quiet day for earnings. Yeah, it's a quiet day for earnings. Melatonin, Azayo, Chewy. Chewy's got earnings after the market closes. Everything else, not a huge bunch that I will be writing home. There's a lot of bioscience. Got a lot of bioscience today, earnings-wise, but not. I wouldn't say there's anything that's really something I want to be sticking around to find out how they perform. Not like GameStop and Nike yesterday, and I chose the wrong one to follow, but you know, it is what it is. Okay, so let's have a look. What else is moving? Let's have a look at the big movers on the day. So the big mover was Zura. Zura, no, that's not really doing anything now. It's kind of fizzled out. Volume's dried up. Just nothing doing there. Next JMac. This didn't have any volume, still doesn't have any volume. How this has moved up with the severe lack of volume, I don't know. GameStop is looking very choppy. Sideways. 24.63, that's just sideways. Looking at the VWAP, it's almost horizontal. Sideways chop. Since about 10 a.m., the VWAP's just horizontal. It's not done anything. $89 Bio. This is the one I traded earlier on the small account, but it didn't do anything. It popped up and then didn't do anything afterwards, and it's still not doing anything. This one, let's look at it on the 5 minute. Let's see what I'm talking about. Here's where I traded it, pre-market. Then we got the devil horns. So we got the devil horns on the 5 minute, and it just sold off then. So yeah, I called out 1550 on this as a level it needs to break above. Otherwise, it's probably not worth considering. And I was right. Okay, so what's next after 89 Bio? Cardio Diagnostics, very low volume. Let's have a look. Across the course of the day, yeah, there's nobody trading it. Volume bar of 4,000 shares. No, there's no. Tell you what I'll do. I want to filter out the volume dogs here. And here. Yeah, it looks like there's not a lot else moving, guys. So what 7-Eleven, what am I trading right now? I'm not trading anything right now. I'm looking for something that potentially could be worth trading. I'm not going to take a trade just for trade's sake. There's no point in doing that. That's how you lose money. But if something pops up, then yeah. I mean, so far I've traded First Republic Bank, $675 on First Republic Bank. GameStop, $150. I was actually down over like 2,500 on GameStop and recovered it. And Zura, we've got 18,000 on Zura, so not a bad day. 3 times gold. So let's see if we can. And plus, I've got 3,500 on the 3,300, 3,350 on the small account, on the other account. So it's a good 20k plus day again. March is fantastic. It really is. March madness. Gotta like what's going on in March. The amount of 20k days I've had in March, or better. Purple innovation. No. There's plenty of movement in the low price stocks now, but there's nothing in the main. That's better. No, that doesn't sit well with me. Let me move that again. Level 1 needs to be next to level 2. That's better. Yeah, that works. That works for me. Alright, let's see. CDIO, no volume. Ollie's barge? Maybe? Ollie's bargain outlet. Yeah, just sideways chop. There's not really much moving right now. And even if we let's look at the losers. Let's see if we get anything worth shorting into the close. I think Zura might be worth shorting actually. Edible Garden. Don't look at me like that. Yeah, this sold off pre-market. So again, it's kind of curling round back up, trying to test the VWAP. So again, that's not something I would say a reliable short. No, I've actually been dry all month, Dilwar. I've not had any wine for a couple of weeks now. Just taking a bit of a break. So I was on the tea. I'll take you out in a minute. Yeah, there's not much moving. Let's go back to GameStop, shall we? Over the $750 level, maybe. Again, the volume seems to have dried up with GameStop as well. 63 million shares traded today. Huge amount of volume. So, put that into context. GameStop normally trades about 4.2 million shares daily. So, this is like 15 times relative volume. So, yeah. GameStop on the back of good earnings. The question is, will it continue? Because you've got the whole meme stock brigade. I mean, you've got the likes of Matt Kors and the rest of them all getting excited because GameStop's had a bit of a pump on the back of the first positive earnings they've had in 2 years. This is the first quarter they've returned profits in 2 whole years. So that's, since the whole debacle around the short squeeze, etc. in 2021. So GameStop, yeah, first profitable earnings results in two whole years. No wonder it rallied. But go UA. AMC, yeah, it's breaking lows now. AMC. So it's kind of deviated a little bit from GameStop. SoFi back down at 560s. Corner under the VWAP down up to 870s. First Republic breaking lows. Let's go back to First Republic here. First Republic. This is breaking lows now. So it went down as far as kind of just under $13 after hours yesterday, and I think it could pretty much do the same thing. It went down to $12.80 after hours yesterday. It's still not quite where as bad as it was on Monday when it went down to under $12, middle of the day. This was a $40 stock last week. Just putting that out there. $40 stock. This went up to after they got the cash injection from a couple of the big banks. They went up to $40. I know because I managed to profit from it, but it's now back down to, it's going to break $14 shortly. I would short this, but it's hard to borrow and on short sale restriction, so I'm not going to bother. I think I've had a good day. So 25 minutes to the close. If there's nothing moving, I'm not going to trade it, but I'll stick around till the close and we'll see what happens. If you guys have seen anything, if you want me to take a look at any stocks, if you want to take me to take a look at any tickers, just let me know. I'm happy to take a look. That's my BDI and give you my oh, Zura's on the move again. And give you my my thoughts. Oh, missed that pump. That's a good what? $3. 28.50 to 31.50. That's a $3 move. That. What's the spreads like now? Because they went really wide. They went like $2. They're not that bad. 70 cents. 60, 70 cents. Moment. Zero. Let me just. Let's put a little horizontal on here. That's the level I'm looking at. 32.50. Starbucks selling off. Starbucks, not Starbucks, in case you didn't understand my accent. This is it launched yesterday, completed it. It's a recent SPAC merger. So this is Zura Bio Limited, and it completed a recent SPAC merger. Its first day trading was yesterday, but it completed the initial offering today, which is why it's taken off. If you look at this on the daily, you'll see. So you can see this on the daily here. Yesterday was its first day. It actually sold off a little bit yesterday, but then it completed the offering and it's just gone mental. It went from yesterday's closing price, 411 to the peak, 411%. So I managed to get in from kind of $19 all the way up to $35. So probably could have got more out of it if I traded it better, but it was very volatile. I'm risky. Big spreads. Very big spreads. Range is huge. I mean, even now it's calmed down a bit now. The spread is very rangy. So yeah, it was a SPAC merger. I'll tell you directly who they merged with. So Zura Bio Limited and says here rockets as high as 273%. No, it didn't. It went up to 411%. Okay, so JATT Acquisition Corps. So that's the SPAC merger. That was the SPAC company that they've merged with. So Zura Bio Limited shares are trading higher as the stock begins trading on the Nasdaq following closing of its business combination with Jet Acquisition Corp. So that's reading verbatim. So Jet Acquisition was the SPAC, and this is the SPAC merger. So that's why it's gone up. So I've not even got the float details on this at the moment. I don't know what the float actually is. It must be small. Yeah, 26.5 million shares outstanding. So it's not a micro float, but it's a small enough float. It's 26 million shares, and it's traded today a very small portion of those. So I reckon there's a lot more shares held back. There's 26 million shares outstanding. I don't know what the float actually is, but there's 4 million shares traded today nearly. So yeah. Interesting action earlier. From about 11 a.m. till from about 11 till 1:30. This was just going absolute bananas. Some of the action on it was just, well, it was great. If you got on the right side. So I got on the right side of most of it, but the last one I was in small, so it wasn't a big deal. But I got in, and it moved in an up halt. I thought I was good with it because it looked like it was going to gap up, and then it gapped down by $2.50. So I ended up losing $2.50 on that. I had a stop in place, which was one thing, and it was only 1,000 shares, so I lost a couple of $1,000. Gave back a couple of $1,000. I was up at like over $20,000 on the day at that stage, but I ended up giving back just over $2,000. So yeah, easy come, easy go. When you're up 20k on a stock and you give back 10%, it's time to maybe go and have some dinner. So that's what I did. What have you done? Let me know in the comments. Have you been trading today? If so, are you profitable? If you're not profitable, what have you found difficult? And is there a stock that you're looking at? Are you holding something? Are you trading something right now? What's been moving well for you today, or not so well, depending which side of the coin you're finding yourself. How much leverage do I get on the account? It depends on the stock, but up to 6 times. I can get up to 6 times leverage. It's painful, Dilwar. Sorry to hear that, buddy. But tomorrow's another day. There's more. Oh. What are the spreads like? Yeah, dollar spreads. What's the range like? $1.12. Nah, there's no point there. If your range is not covering the spreads, it barely covers the spreads. You got spreads of $1, and the range is a little over $1. So you need at the very least, a 2x. Between the range, the average true range and the spreads. Otherwise, how do you expect to take a profitable position? Limit orders, mostly limit orders, Neith. But saying that, at one stage I couldn't get filled. I was trying to get filled with limit orders, and I had to put some market orders in there just to get filled. So it depends. But when it's $1, you're probably better off going with market orders when it's like a dollar spreads. At least that way you're gonna get filled. And this is not the type of stock you want to be trading out of regular hours. It's just going to be mental. So we might get a continuation tomorrow. We're coming up to the top of the hour. I just don't like this. The spreads right now are 50 cents. The range is $1.17 and change. Exactly. So when you look at just looking at the volume here, the volume died down. It's now coming back in. It's never been great volume. It's never been huge volume, but you know, if you're getting like 25, 30,000 shares a minute, that's fine. Which we were earlier. So we're getting about 30,000 shares a minute earlier when I was trading it. Between 11 and kind of 1:30, we were getting 25, 30,000 shares a minute, which was good. Yeah, exactly. I saw $2 spread on it earlier today. I mean, the spreads are like 50 cents at the minute. Anywhere between 15 and 50 at the moment. Might take 500 shares. Let's see if I can get an entry. Spot an entry. And when it's like this, what you want to be doing is you want to be sizing down. It's all about expectations. If you start getting really rangy spreads and the volatility is huge, then you don't want to be going in big size. I did that with Luna, I think it was, and it frightened the hell out of me. I think I went in at one stage 5,000 shares, and the spreads widened to 70 cents or whatever it was. Frightened the life out of me. No, it wasn't. It was $1.50. Spreads went to $1.50. Like 7,000 in the hole, and the ask hadn't moved. There was no movement on the ask. It was just the spreads widened. Got in for, I think the spreads were about 30 cents. It was Luna. It was Luna. I'm pretty sure it was Luna back in the day. But the spreads were like 30 cents when I got in, and they went up to like $1.50 after I got in. It was the price action hadn't moved on the ask, so if I bought back in at the same price, it wouldn't change my I wouldn't be averaging down. But I found myself like $7.5 grand in the hole with it without even without any movement. But look. It's a risk you take. It's big risk for big reward. Stocks like this. It's a bit choppy. I'm not seeing any clear entries here right now. I'm looking at multiple time frames as well, and I can't see it. Actually, I'm on the 2 minute. It's saying don't do it. $36 is a new high of days, really what's needed. And at the moment, going into the last few minutes of the close, probably not the best time to be taking trade at the high of day. FRC, First Republic Bank, breaking new lows. AMC breaking new lows. It's gone red on the day now. AMC. Yeah, the market's breaking new lows. Well, it looked like the market was reacting positively, and then Powell said there's going to be no rate cuts, and that's why you don't want to be going in big size. Look at that. $3 flush on that one candle. Into a halt, into a down halt. I'm glad I didn't get into it now. I was looking for an entry, couldn't find one, and now it's just flushed $3 down in that one candle. If you take the candle before it in addition, it's a $6 move. Well, no, $5 move, 36 to 31 into a halt down. And what's the... Well, it's $31 right now, and it's looking at resuming at 27. So if you were up at, if I got in at like 35 there, it looks like it's going to resume on this this halt at 27. That's a $7 move. Oh, $8 move. That could have been painful. I'm glad I didn't. Looking for an entry, couldn't find one. The 2 minute. So look at, if you look at this. So So I was looking on multiple time frames. I was looking at the 5, couldn't find it. Then I was looking at the 2. Here on the 2 minute, this upwick, shooting star, if you will. It's a reverse. That looks like it's got selling pressure, so saying don't take me. So there was nothing on the 1 minute, and then look at that. It's just painful. Strong surge after the halt. Well, it's going to gap down, Neath. So the question I would ask is, right now, how long is the halt going to be? Because at one stage we had a 20-minute halt. So it wouldn't surprise me if this is now halted into the close. So it halted at 47, so it should resume at 52. 15:47 is the halt time, 15:47 and 10 seconds. It should resume at 15:52, 5-minute halt. But if they could just halt it into the close, and I've seen that happen a few times in the past. But 411% this went up today to the peak. I'll show some of the trading on the recap. I've just dropped the small account recap there later as well. Dilwar, what's my total for this month? That's a good question, Dilwar. Let's have a look, shall we? If I include today, let me just give me a second. I'll just import today's trades. Right, okay. Right, okay. Yeah, I can think. I think it probably is going to be a red day tomorrow. Devil horns at the bottom, sign of the reversal to the upside. Maybe I don't. Devil horns at the bottom, a sign of reversal to the upside. So basically, I call them sparrow legs. But yeah, if you get it's the inverse of the devil horns at the top. Yeah. Yes, it does, Neath. So I've got a resumption at $30 right now. So it looks like it's going to be resume level. It looked like it was going to gap down to 27. Now I've got it's moved to $30. So it looks like it's going to resume level. So it's 47.10. So 52.10. I'll just hold before I cut across to the numbers there, Faz. Oh, Dilbar, I'll cut across to the numbers. I've just imported the trades. I'm not taking any more for today, so I'll come across what we did, and we should 10 seconds get a resumption here. I'm gonna lock my montage so I don't accidentally take a trade. Okay. Maybe we're not going to get a resumption. It's a little bit delayed. Okay, might be. Like I say, it might be a longer halt. I can't see any like the halt code. It doesn't give me the halt code, unfortunately. So I can't tell whether it's a 10-minute or a 5-minute. But the 5-minute would have been. That's bloody loud. But the 5-minute would have been resumed by now, so we'll come back in 5 minutes and do that. Yeah, that's what I said, Neith. It looks like a halt into the close. Yeah, I think I am trading better off the wine. Let's have a look at the actual statistics here, guys. So Dildar's wanting to know what I'm actually on. So today I've just imported the trades from today. We've had 3 5-figure days this week, and we had a great week last week as well. So this month I've got it filtered from the 1st of this month. So right now 245k. 245k in 1 month. That is just it's my best ever. It's my best ever month. My best ever month was January. I mean, if I cut for the year, up until today, my best ever month was January. I had 175k in January. Was the days and times. Days and times. And look at this. So 175k in January. I had a blip in February, but 245k. I tell you what, I might not be the best. I might not be the best trader on the internet streaming live, but I reckon I'm definitely top 3. Definitely top 3. So for March, it's definitely a good month, and we've still got. Let's go back to the calendar here. So how many days have we got? So we've still got 7 days left to trade in March. 2 this week and then 5 next week. So there is, I'm not saying I will, but there is a potential I could have a 300k month. So 7 days, if I did 10k a day, that would take me to yeah, that would take me over 300k, 10k a day, and just this week I've been doing over 10k a day. So I'm actually averaging across the whole of March at 15k a day. So yeah, long may this continue. This is just unbelievable stuff at the moment. It really is. So yeah, let's go back to the action. It's still not resumed, and yeah, so it's not resumed yet, but we'll see what happens. Oh yes, it does. It does, Neith. Yeah, so I've got my level up, level down. When I'm in there, I've got my level up, level down. So I know the halt levels up and halt levels down. That's right on the level. It's on the level 1. It's right underneath the volume. This is going to be halted into the close, I think. So we're looking at it halted at 47.10. So we should 20 seconds get a resumption, or it's going to halt into the close. And I'm feeling this is going to halt into the close. Bank turmoil, absolutely, Jack. That's what's give me the March performance that I've had. So this time last year, it was the oil sector, it was the energy sector was on fire. Not literally on fire, but it was very, very bullish, and I managed to get some really good results out of the energy sector. Indonesian energy was a big one for me last year. This time last year. Yeah, we're just going to finish up at the close there, David. We just waiting to see if this. No, this is not. This is going to be halted into the close. So yeah. Yes. So if a stock's at $30 and it's going to be halted at 35, I've got that level on the on the montage. Yeah, I see that beforehand. If you, I tell you what, Neith, if you join me live every morning, I'm at 8:30 every morning. I start streaming my live trading for 2.5 hours. You'll see when I'm, particularly after the open, because you don't get halts, volatility halts in the pre-market, but after the open, you'll see me calling out the halt levels before they actually halt. So, and check out some of the, in fact, today, when I do it, there'll be a halt. I got caught in a halt today, so I've recorded that. You'll be able to see that as well. And when I do the trade recap in a few minutes. I'll drop that, and I'm calling out the halt levels, what the halt levels are and stuff. But you see them before they halted, because you hit the halt level on the ask, and you still get some trading going through before it actually does halt. Now you can get an order in there, you might not get executed. Very often it doesn't, but it's a good, when you're doing that, it's a good time to put your stops in if you haven't got them already. I don't know, some of these songs and some of these tunes are really good, but they're just a bit loud. All right. Yeah, so we've got 30 seconds to go. This ain't going to resume. What I'm going to do is I'm going to see where it opens up after. It should. As soon as the bell rings, the close, it should just resume trading after hours. But I'm not trading after hours on this one. Watch the spreads widen. You'll see huge wide spread. I mean, the spreads were wide in the regular session. So if the spreads were like $1.50, let's see what they go to in the out of hours session on this. There we go. It's just resumed. And the spreads are $3.16 spread. Look at that, more than. But the $6 spreads. Aren't you glad you weren't caught in that halt? Could you imagine? That's just dropped almost $10. So, yeah. Yeah, it's after hours, can't halt in the after hours. Well, it can't have a volatility. There's no volatility halts in the after hours, but like the pre-market session as well, you can get halts. It can be halts news pending and halts pending investigation. Now, those are the two types of halt you don't want to be getting caught in. Volatility halts are okay because we welcome volatility. We like volatility. But if you get caught, so I don't know if Dave's on or not, but Dave Trade was on. He was shorting pre-market Silicon Valley Bank with me, and I cut I was in a short position and I cut it as it started to move back up. He held on to it into the halt. And it's still halted now, so his position is frozen until it comes out in the wash. The good news, he was shorting it, so it's effectively gone to zero. He'll get a lovely smashing payday on the back of that, but it's just going to take time for it all to unravel. If they could have found a buyer, because they're breaking it up now, so it's just going to definitely go to zero. If they could have found a buyer, it might have hit the pink sheets, the OTC markets, in which case we've had a big payday, but not the full thing. So yeah. Yeah, so I didn't do Jan. There just wasn't enough volume on Jan. I mean, Zura was reasonable volume, wasn't huge. But it was good enough to trade. It was predictable enough to trade. So that was the thing. So look, going back to what I was saying, check out the links in the link tree. Check out the links in the description. I use Benzinga before I sign off. In fact, I'll do it the real way. Okay, and. If you are wondering how I find these stocks as they're breaking out, when they're breaking out, etc., this is how. I use Benzinga to find stocks that are breaking out. Benzinga. This is my Benzinga. I showed this earlier. If you weren't on the live stream earlier, you probably missed it. But this is my Benzinga table. I'll just do this for the after hours. So I've got gap scanner here. I've got my momentum scanner. I've got my real-time scanner here. I've got my signals, and then I've got my rolling news here as well. So this is what I've got for Benzinga. But what's great about Benzinga is that you can, so for example, I can just pull up the calendar there, and straight away I can see what's going on with the calendar eventually when it resolves. In your own time, Benzinga, you're making me to look like an idiot right now. So it will open by default on earnings. So straight away you can see, who's got earnings tonight, who's dropping the earnings. You can watch them for any after hours action, or this morning you might have been looking at so this is after hours. So Chewy's got earnings dropping this evening, but also you look at what I like to look at is economics. So today, for example, we've got economics would have been here. So I look at this every morning, and straight away you've got the FOMC press conference when that's out, the Fed interest rate decision when that's out. We've got the oil, gasoline inventories, that kind of stuff. Energy stocks, all this kind of stuff. You got IPOs. There's no IPOs today, but you got IPO data. All of this stuff, it's great at the touch of a button as well. It's fantastic. If you can get the info on all of these stocks at a click of a button as well, and it'll tell you what's going on. So if you want to check that out, you can do so. You just go into my link tree. These links are all in the description on YouTube as well. Yeah, you get a better price if you do decide to use Benzinga, you get a better price using this one. So use this link, check it out free for 14 days. You get a trial for 14 days, and then use this code if you like it, and I'm pretty sure you will. It's absolute gold. Use DTWT, Day Trade with Tony, DTWT 35, you get 35% off. It's a bit more expensive. I think it's $177 is the list price for a monthly subscription. If you go for a longer term, a quarterly or annual subscription, it's much cheaper, but you get 35% off whatever package you decide to go for using that code. So by all means, do that. Yeah, I'll catch you tomorrow, Alistair. No problem. No problem. So yeah, if you want to learn how to trade, by the way, I was just looking at the statistics and how I'm doing in March, having a fantastic month in March. TraderView, log your journal. There's a whole bunch that you can use, but I recommend TraderView because that's what I use. So these are the tools that I use. This is why I recommend them. The only tool I don't use here is the learning to trade, because I'm actually doing it. So if you want to learn how to trade, use the methodologies and strategies that I use, then this could be for you. And it's the full syllabus there. You've got for $120 a month, $150 a month. It's an absolute steal. And you get access to the Discord as well. So I was calling. So when I got into Zura, let me just pull up the Discord here, so you'll be able to see. So this is my Discord here. And let's see on the watch list here. So where did I get in for Zura earlier? There you go. When did I call it out? So these people in the Discord here. Okay, so here you go. So Zero, this is when I called it out, 330, and I didn't trade it straight away. So big spreads. That was the warning. Big spreads, but huge average true range. It's high risk, high reward. I went away, walked the dog, came back and managed to get the break of $20. It then halted up. I had 2,500 shares at the time, and it resumed at higher, so I managed to get a good result. But this is the Discord. You've got all kinds of different things. I do live trading in the Discord as well here, so I don't want to be doing that right now. I'm just clicking out live trading. I'm streaming live in the Discord as well, so by all means, come join the Day Trade with Tony community. You get access to the Discord as well, and we do that every single day, and I will be doing it again tomorrow. So that's me done, and let's. So I'll be doing it again tomorrow, an hour before the market opens. Come join me then. It's 8:30 market time East Coast. It's 12:30 GMT. Is it this weekend that the clocks go back in Europe? I'm not sure actually off the top of my bonds. Or is it next weekend? It's this weekend. Yeah, so it is this weekend. So the clocks go back this weekend. Okay. So yeah, come join me tomorrow now before the market opens. We'll do it all again. In the meantime, take it easy. I'm out of here. Oh, so ATR need. Well, before actually, I've just dumped the TikTok crowd. Before I dump the ATR, I've got it set on my volume profile down here. This line is my ATR. Okay, but I look at the numerical value of the ATR, so the average true range, and now I could map it on here as well if I wanted to in terms of ATR, but the average true range I've got here 1.277, so $1.27 and change. So that's where that's what I'm doing. Okay. That's where I've got my ATR. That's how I see my ATR on the 1 minute. I've got it on the 5 minute as well. On the 5 minute, the ATR is 270, no, just shy of 277. So that's where I see my ATR. And I see the level up, level down on the. So you got the montage over here, where the level 2 is. Just under that, I've got my level up, level down, and that shows the. That shows where the halt levels are as well. Okay, I'm going to record the recap now, and I will see you guys tomorrow. Take it easy.